Okay, how come it's not letting me go?
Hello, everyone. Let me see. Hello, everyone, and welcome to the Cash Flow Management webinar. I am Eileen Villa-Golden from the Maricopa Small Business Development Center, and I will be facilitating this webinar. I will be monitoring the chat through the webinar, so if you have any questions, make sure to put them on the Q&A so they do not get lost in the chat. As everyone is joining us, would you all introduce yourselves in the chat, please? And now we will be having SBDC speaker Rick Spears give us an overview of the Maricopa SBDC.
Thank you, Eileen. Good morning. So today we're going to talk about cash flow and why business owners should prepare annual budgets, include calculations of their cash flow as a part of that process. It's a standard practice for very large companies. I have a background with large companies. Some small business owners, though, may think that they don't need this discipline. And for the fortunate few, that may be the case. But for most, we find that they want and need a process to manage and predict their profitability, their available cash, and their cash reserves. So as you can see, I'm one of the bankers of our Maricopa SBDC staff, and you've met Eileen, and Anna Manier is here as well, who's providing webinar support. So I appreciate both Eileen and Anna helping me out. Over the past 2 years, we've assisted clients in obtaining business funding well in excess of $100 million. A lot of that was brought about by the pandemic relief afforded through the SBA's Paycheck Protection Program and SBA EIDL loans. During this difficult time, we also assisted clients in obtaining both SBA 7A and 504 loans, as well as a lot of conventional everyday business loans through our many lending partners. What we have found almost universally is that clients that understand cash flow had both cash on hand and the cash reserves to get through this catastrophic last couple of years. In fact, there were some that were positioned to grow by being able to take advantage of this unprecedented market disruption. So a real quick advertisement for an explanation of our Maricopa SBDC. The Maricopa SBDC Small Business Development Center is part of our statewide network, SBDC Arizona, which is accredited nationally by America's SBDC. Our SBDC is funded through the Small Business Administration and hosted by Maricopa Community Colleges. We also partner with the city of Peoria, Arizona, and the Arizona Commerce Authority. We are not, though, the SBA, nor do we lend money or provide capital. We help our business clients obtain their needed financing whenever possible through our many resources and partnerships. The Maricopa SBDC mission is to guide, educate, and support business clients, whether pre-venture, those just starting out, or those that have been in business for a long time. Our no-fee counseling focuses on helping clients launch, grow, and sustain their small businesses. We have a team of seasoned business analysts that have experience in many industries. We have specialists in business funding, export, international trade, technology, marketing, and manufacturing. The Maricopa SBDC also offers research and training programs with access to tools and resources to help with business development. We have relationships in place with many different lenders. We understand that what those lenders are looking for. We provide lender referral contacts and help clients prepare a lending package that meets that lender's requirements and help streamline the lending process decision. So a business can fail if they don't plan and budget. Those plans should also forecast cash balances. Your plan needs to adapt for contingencies on a daily, weekly, and monthly basis. The sooner you can identify a problem, the better. more time equals more alternatives. As we all know, many business surprises are negative. Now, it's not a whole lot of fun to budget and constantly monitor the budget, but knowing your going forward cash position is a critical data point that you need to better manage your business. Business owners that have their fingers on the pulse of their business going forward stand a better chance of success than those that don't. Okay, so not always the easiest thing to do, but that's why we're here. That's why we want to get started. We can make cash flow management look difficult, but it is a fairly simple concept. How much money is coming into your business and when, and how much will you spend and when? I like the next slide because it illustrates the basic fact that to stay in business, you need to make more than you spend. It's the same as how we manage our personal finances. Anyone over the age of 30 has probably used a cash flow statement in their daily life. It's a checkbook register. This process, cash flow management, is like reviewing your checkbook register or bank statement. Cash in and cash out with more deposits, hopefully, than checks or debits. You probably have a target amount in mind that you are comfortable with at home, and your business is no different. You'll sleep better for it. Money in the bank doesn't always necessarily mean that you should spend it. It's almost always better to acquire an earning asset or revenue generating expense, something or someone that will help grow profitable revenues. Say a faster machine, more digital marketing, a new salesperson. Remodeling your office may not measure up under those criteria. And as always, having cash reserves is vital to overcome unforeseen events. So here's a sample of a typical cash flow statement. There are other formats depending on your managerial needs. In the past, cash flow statements would also have been known as a source and use statement. All formats, though, have three core parts that show changes in operations, your P&L net income or loss, and changes to your balance sheet assets and liabilities. And changes that are due to investment activities or financing activities. By adding your starting cash balance, you arrive at end of period available cash. Comparisons are always to the prior reporting period, whether it's last month or last year. That means you're going to need two balance sheets, both the prior period and the current, and your current P&L. And the next report shows a completed report. So here's an old published report from a company you might recognize. While it's undoubtedly complex to prepare, and I'm glad I didn't have to do it, at its basic core, it's just a check register. So let's talk a little bit about low cash and low liquidity. It could be that your business has too much inventory or the wrong inventory. Could be slow account receivable payments. Are your terms too generous? Aggressively, or do you aggressively collect them? You know,
Hey, Rick,
yes.
excuse me. I think we went back a slide instead of forward a slide.
Whoops. Okay. There we are.
There we go. Thank you.
That's why it takes two people to help me. So, you know, here's an actual statement taken from the annual report of Amazon several years ago, which shows their widely fluctuating increase in cash and cash equivalents, something on the order of, you know, 6 billion, 1 billion, and 3 billion in successive years. So going back to cash and liquidity, as I say, you could have the wrong inventory or too much. Your accounts receivable may be too high. You know, a possible fix to that, I see a lot of companies now are taking buyer credit cards instead of sending out their traditional 30-day due invoices, and, you know, receiving their credit card proceeds and anywhere from the same day to up to 2 business days. Another reason for low cash or liquidity can be the lack of a short-term credit facility, business credit card, line of credit, a factoring arrangement, not my favorite. To to take care of your temporary cash needs and to fund the time between your receivable and payable timing or your inventory purchases. We see a lot of liquidity issues here in Arizona as a lot of businesses have felt the impact over the years of the snowbird season and the resort seasons that we have. The good news is, I guess, that we're having more year-rounders now than we've seen in the past. Another source of low cash and liquidity is long-term financing for your fixed assets, whether it be for equipment or a building, where the amortization can be stretched out 5 to 25 years. An example, if you take out a $50,000 equipment loan, payments on a 3-year basis are going to be on the order of $1,500. If we're able to stretch them out to 7 years, they're more than half that, more than 50% less at about $730. Another thing that we've seen in the last few years is undercapitalization, where low equity positions by the owners and high debt means that the financing costs are eating both cash and profitability. And finally, low profitability or operating losses. Again, business success is all about running a cash profitable business. So simply put, 3 parts to the cash flow statement: operating income, which is the key. Are you running a profitable business and getting paid? Your investment activities, how you spend the profits you generate, and any financing costs that are required to build your business. Cash flows do vary from industry to industry, and there are different metrics that we can help you out with, depending on what business you're in and how well it enables you to determine how you match up against other companies of your type in the markets that you serve. Lastly, in many years of reviewing business performance, I found as many companies have trouble, not because of the profit they make, but because of what is spent and taken out of the business. No more was that no more evident than in 2021. So enough of kind of some of the theory part of this. Let's walk through a more practical example of how cash flow can impact a hypothetical business and how an owner can pivot to make things happen instead of let them happen using our tools. So for the purpose of the budget we're going to build, we'll assume the yellow entries are the budget numbers, and those in the green entries are what actually occurred in the first quarter of this year. For convenience, we use our stress Excel template that allows both good and bad what ifs. It enables us to make changes as need be in our client scenarios. In this example, actual net income results are going to fall short of the budget in the first quarter by $2,300 or 17%. We take a closer look at that. We're going to make it fairly simple and just show that the budget for every month is the same: $10,000 in revenues, cost of goods sold are the same, gross profits the same, operating expenses, and after tax net income are all the same. And then we show next to it what we actually are assuming occurred. So their net income actually was $775 less for 3 consecutive months, or $2,400. And if we do that, we want to take a look at what the effect of cash is. So they began that first quarter of the year with $5,000 in the bank. They had planned on earning $4,500, so they assumed that they would have $9,500 in the bank. In fact, because their earnings of $3,725 or less, they ended up with a cash balance of $8,700, which gets carried over either on a plan level or actual basis to the following month, February. By the end of the second month, the same thing occurs because of that $775 shortfall in income. So they end the quarter, instead of having their budgeted $18,500, having $16,175. So if we stop here, you might say, well, it's not really a lot for the owner to be worried about, right? Well, probably wrong. Knowing your cash balance after considering only your P&L results, your operating results, fails to consider how you spend your cash. The investing and financing segments are the other two cash flow management criteria that affect business results. While business profit is a source of funds, these two factors often show up on the usage side. In our example, we had planned for our $1,700 a month loan payments. What we didn't plan for in February was for our computer system to fail, and that cost us $4,000 to replace. Even worse, what if your delivery truck stopped working in March? Because auto dealers don't have any new inventory, you couldn't lease a new one. You had to put a $7,000 down payment on a used truck. So instead of the budgeted quarter end $18,500 in cash, or the actual results that we've shown so far of $16,175, your balance could fall to either $9,400, or if you ended up buying that truck, $75. But enough of this woe is us example. So let's look at what this owner began to do before January 1st, because he planned and budgeted. His prior fourth quarter profitability was not what he anticipated because of COVID. He had planning on starting the year with $8,000 in his bank account, not the actual $5,000 that occurred. He had previously, though, established cash reserves he could draw on if needed. He had a bank credit line of $25,000, or had the ability to add some personal equity into the business. As a result, if his cash balance threatened to fall to $75, he could draw against his $8,000 line of credit, and worst case, end up with $8,075 in the bank. So if you keep profits in your business, your retained earnings and cash will help you through these lean times. But establishing loan facilities in advance or having personal resources is a prudent step to make sure that you can survive some of these unforeseen events. As I said in the last slide, the owner didn't like the way the year started, so he began to plan and budget. So far, we've ignored why his cost of goods sold and operating expenses were higher than budgeted. We need to move one more slide. Oh. His cost of goods sold were higher because he added free shipping and delivery to his selling proposition. Because his fourth quarter sales were down, he also started the year spending $100 more on his digital marketing campaign. And he intends to continue those initiatives through the end of the year. Sometimes higher than budget expense variances are good. Why? Because let's look what begins to happen in April or the start of the second quarter. His revenues jumped 35% over budget to $13,500. His April profit of $7,700 not only wipes out the year-to-date first quarter loss, but actually he now, after 4 months, exceeds the budget by $900. But what happened to his cash flow and cash balances, even though he had this successful start to the second quarter? Well, while he got caught up on year-to-date net income, because of timing, cash flow still lags. Despite the strong month, his bank balance of $13,000 is still 32% less than what he had budgeted at $19,000 for a $6,100 difference. But if he can continue his April performance in May and June, the likely added cash flow from operations will allow him to catch up. That assumes, though, that there are no more unpleasant expenses, investments, or financing surprises. It would also suggest that if this strong performance continues through these actions he's taken, that he take the opportunity to build his cash position beyond even his budgeted level. Evidently, though, this owner is confident in the corrective steps he's taken as he paid down his loan by $1,000. So we're all probably bleary-eyed from the numbers by now. I know I am. And if we look at this summary, the changes, good and bad, look pretty simple. Year-to-date net income up, loan proceeds were required. He started the year in the hole in terms of his cash balance. You know, worst case, he buys both equipment and a new truck or a used truck, and he made a loan repayment of $1,000. So that's where that $6,100 variance comes into play. You know, again, it looks simple if we summarize it, but it was anything but as we went through the spreadsheets. And it's, again, emphasizes why planning, evaluating, and adjusting are keys to better results. And a budget's much more informative if it projects expected cash results. Again, nice knowing that you're $900 over budget at the end of 4 months, but a $6,100 budget cash position takes away a little bit of the luster of that. So, you know, if you go through these exercises, give it your best effort. It doesn't need to be perfect. You'll quickly identify the key performance indicators that most influence your individual outcomes. So, as one of my associates had said in the past, here are actions to consider to look for the budge in your budget. To find cash flow opportunities, you need to scrutinize every aspect of your P&L statement and your balance sheet. Remember my earlier comments about the whys of low cash and liquidity. It's an essential part of budgeting is what will it look like if you do these alternative things, doing what if scenarios. In our example, by increasing variable costs in delivery and marketing, the business dramatically grew revenues even beyond what they had projected based on making those expenditures. So talk a little bit about debt service and borrowing. Borrowing's frequently a business necessity to both grow your company and meet any cash flow needs that may occur from time to time. In our example, the business had $1,700 a month in loan payments due. In order to qualify for that loan, the company would have had to demonstrate that they could pay back the loan, and the term lenders use typically is debt service coverage ratio. And the ratio expected is usually at least 1.25 to 2 times the payment amount. That means that operating income must be greater than the loan payments by that percentage cushion that the lender's looking for. In our example, the company would have had to assure the lender that their operating income would be at least $2,100 a month, or 1.25 times $1,700. As a general rule, short-term debt, whether it's business credit cards, lines of credit, are paid from cash flow. Long-term debt for term loans, for that idle loan you may have gotten, for commercial real estate mortgages, is paid from net income. They all ask for collateral, but that's always a secondary source of repayment that they don't and you don't want to have to draw upon. So again, a word about cash reserves, which I find is a pretty neglected point of emphasis with small business. Many mature businesses have weathered their lean startup years and with prudent management established a healthy cash reserve, typically in retained earnings as a result. Now, for instance, if you have $1 million bank balance and your expenses are $10,000 a month, you'll run out of cash in 8 years and 4 months without earning a dime. But if you're not in such a comfortable position, begin to build your retained earnings and preserve cash. The other thing we see frequently is there's a real risk in running a company in what I call paycheck replacement mode, where reserves are not established sufficiently. Well-run companies have at least 12 months reserves in their balance sheets, along with additional off-balance sheet contingency sources like lines of credit or personal assets. And something you don't want to overlook, even though it's, an expense certainly, is making sure you're adequately insured for business risk. You don't want to miss the opportunity to be funded for inopportune events by not having the proper level of business insurance. So a word about cash and accrual accounting. Cash basis accounting tells you what's in your bank account today. Probably most important, right? You always know your cash flow and cash balance. You may not know your current period net income without doing more analysis to subtract some of the other period cash events. Accrual accounting is theoretically more accurate, as it better matches the timing of when revenues and expenses are recognized, earned, or expensed. So you always know your assumed income, but may know the when of cash flow. Your customer that owes you a $10,000 accounts receivable on accrual basis isn't of any benefit till it's paid, right? Could be a bad debt, and you've spent cash to provide the service or product. So until you're paid, you haven't earned a gross profit on that sale to cover your costs, pay expenses, generate income that builds your bank balance, and later cash reserves. EBITDA is largely a P&L look at how much cash comes from operations when you deduct non-cash items like depreciation. It only reflects past investments and financing costs that impact the P&L statement. You've got to have cash to pay off a loan, or you've got to borrow if you need a new machine. EBITDA doesn't account for that need until after the fact. A cash flow statement shows if you have the necessary cash on hand or the ability to service any new debt. Beyond EBITDA, we hear the terms working capital, which is current assets minus current liabilities. And obviously having positive working capital is, of course, the objective. It's a measure of solvency, liquidity, and operating efficiency. And it's all data that comes off of your balance sheet. When net working capital is positive, a business has the potential to grow and invest in that growth. If it's negative, growth may suffer, and there may be problems paying bills that come due. The composition of working capital is important too. Having $100,000 in cash on the asset side is more valuable than $100,000 of last season's unsold inventory. And then finally, we hear free cash flow, which is another measure. It's leftover cash after everything's taken out. It's the indicator of a business fundamental health. A quick comparison with EBITDA. Let's say our sample company had $100,000 in EBITDA. If the company doesn't buy that $50,000 equipment, free cash flow and EBITDA are about the same. But in the year that they buy equipment, free cash flow would obviously be $50,000 less because it was spent on equipment. Free cash flow can also tell from working capital data that despite 5 years of consistent $100,000 earnings, the trend of higher accounts receivable, lower payables, and higher inventory could portend to declining company performance. So a little discussion of contribution margin, which is kind of a handy dandy way to know where your break-even point is. And contribution margin is defined as revenue minus variable costs. So knowing the amount of revenue you need to break even is a handy tool, as I said. Obviously, you want to do better than break even. To develop that point, you must first separate your fixed cost expenses from those that are variable in nature. And the contribution margin represents revenue that's available, left over, if you will, after subtracting the variable costs that produce it. By applying the contribution margin to the remaining fixed cost expenses that need to be covered, you determine the amount of revenue needed to arrive at zero or break even. And this technique also works for new initiatives that you might be considering, say buying a new piece of equipment like in our earlier example. In the example I gave, if the budget operating expenses were $24,000 and they were all fixed, then the company would need $68,600 approximately in revenues to break even. And in our example, they had budgeted for $120,000. So a lot of what I've shown today and what we have available to our clients are some of these SBDC resources. Growth Wheel we use for both business plans and a lot of in-depth running of your business. It helps business owners focus on specific areas of their business where they need help or where there's what we call that budgeting. Live Plan we use a lot also for business planning and for doing pro forma projections. We use that an awful lot for people that are preparing to get lender ready, as we like to call it, getting ready to go to their bank or a lender and ask to borrow money. Profit Sense is an industry comparison that allows you to compare what you do to what other people in your industry do. We can further define that by revenue size. We can do it by state. We can make a national comparison. So it's a very handy way of looking at the metrics for what you do. Every business industry has different characteristics and metrics. So Profit Sense is a good tool for that. Profit Mastery, much like Growth Wheel, although much more in depth, is a management analytic toolbox that helps you really understand the numbers based on the decisions you make. That's where the contribution margin calculation came from, for instance. As part of the national SBDC, we have access to SBDC Net, where they do research reports on critical information such as intellectual property, trademarks, copyrights, patents, and so forth. And then lastly, IBIS World is another trusted industry research tool we have on thousands of industries that gives you a second perspective along with Profit Sense as to what's going on in the business that you're in. So if any of you on the session today are not already our clients, here's how you can request our no-fee assistance. Simply go to www.maricopa-sbdc.com and request our help. So, questions? Went through this pretty darn quicker than I even thought. I hope you picked up an idea or two that you can take back to your business. And we, as I say, we've covered a lot of material. So I guess we have some questions here.
Yes, and thank you so much, Rick, for your presentation. As you mentioned, we are now going to go into the Q&A session. I have a question. There's a question that asks, is Excel the best tool to manage your cash flow?
Can you hear me, Eileen?
Yes, I can.
I like Excel a lot. There's a lot you can do. It, you know, as an office product, it takes a lot of inputs. You can download your bank statement, for instance, to Excel. It works with QuickBooks. You can use it to go into some of the tools I've showed you, for instance, Live Plan, and so forth. So I do like it a lot. I find it to be pretty darn flexible. And in all honesty, it's my go-to tool when I'm doing these sorts of analyses. A lot of the tools we've developed here at the SBDC on cash flow and and financial analysis are based on Excel.
So thank you, Rick. I have another question. For a small business owner, how important can you emphasize cash flow management, Rick?
Well, if you're Warren Buffett and have billions of dollars, it doesn't much matter what happens today. He has the cash flow to cover it.
Mhm.
And a lot has to do with the context.
Mhm.
Let's say a business has $100,000 in cash. If you're a food truck owner, that's probably a pretty darn good bank balance. If you're General Motors, that probably won't even pay the small expenses in the next hour. So you've got to have it proportionate to your cash need. And just like in your personal life, you have savings set aside of maybe 3 to 6 months. You need at least that for your business, because there are more uncertainties in running a business typically than in your personal life. I like to see 6 to 12 months of operating expense in cash flow, in cash balances and reserves. I think it's important to establish some basic business credit lines if you have the capacity, whether it's a line of credit or a business credit card. I mentioned insurance, which gets overlooked because people say, well, I don't have the money for it. But if a catastrophe happens, it's good to have insurance coverage. So there's nothing more important to running your business than selling or providing the service you're doing at a profit and getting paid in cash. Until you get paid in cash, and when you get paid that cash, you really don't know how successful you are in running the business.
Yes. Thank you, Rick. We also have another question that says, is there a database of Excel templates available through the SBDC?
Probably not, but I guess it depends. If they're fairly standard, like balance sheet and income statements, you can, when you go on to Excel or Word, as you know, they do have a lot of already out there templates that you can use. We do have Excel templates that we can use from time to time on these subjects. So yeah, if you're a client, just let your counselor know. If you're not a client, sign up and we'll see how we can help.
Yes.
So.
Yes, and I want to emphasize to all our participants that when you become a client with the Maricopa SBDC, it's very simple. And all you do is you go to our website, as Rick mentioned, www.maricopa-sbdc.com. You fill an electronic request for counseling. And there, if your business is just an idea, you're starting, you need to grow, you're ready to move to the next level, or you need some tips on how to manage it, please sign up for counseling today. We have an amazing team of business counselors and analysts who are here to help you. Like, for example, Rick, in your business. So please do not hesitate to just ask us questions. Like I said, we don't just open to, even if you don't have an LLC yet, or you just know what your business name is, we are welcome here for you all to help you all. So thank you all for joining us. Also, I do want to invite everyone to our 2 events next week that we will be having. On the 19th, we are having a stress test your business now. We're actually having 2 of them. On Wednesday, it starts at 8 a.m. It's from 8 to 8:30 a.m. and 7:30 a.m. to 8 a.m. on the 20th. Rick, can you just give us a quick invite for the stress test? Give a little teaser as to what our stress test event will be about.
Absolutely, Eileen. So what we do with the stress test, and it goes back to one of our earlier slides. In fact, let me just go back there. Maybe I can't. Doesn't want me to go back. We have an Excel spreadsheet where you can load your expected. Well, typically we start with the profit and loss, and we can adjust up or down, and it's what my hypothetical company did when they had their April results. we can take Excel, load your base data, including your bank balance at the start of that period, and determine if you're going to be profitable and determine what your cash balance is going to be at the end of that particular month, if we start with month one. Then we can say, what would happen if you increase the number of units of sale you had, or if you increase the sales price, or if there was some combination, if you raise your price 10%, you're going to lose 2% of your volume. We can do those sorts of computations on cost of goods, your operating expenses. What would happen if you hired a new sales manager? What would happen if you began selling your products on Amazon? You load those assumptions in. It runs down to the profitability. You determine if you have to do any investing in finance. It gives you your bank balance, and you can project it out using those sorts of differences. So that's what our stress test is. We actually haven't used it much in the last 2 years because, frankly, with the pandemic, everybody was stressed. So about the only way was up because of how much business suffered in the last couple of years under COVID. So that's a very handy tool. I remember doing one example where the client they had done it for 3 months and the client ran out of money the following week of the 4th month. So with 1 more week's analysis, they were going to be overdrawn, and we had to come up with some sort of an alternative to avoid that. So yeah, it'll be real quick. Basically, it'll be like one of the slides I presented earlier. And it's a what if. What happens if I do this? What happens if I do that? What happens if I'm a hardware store and all of a sudden next door to me Home Depot comes and I have to match their prices? So that's what it's all about. It'll be short and sweet and gives you food for thought about, again, budgeting and managing your business. And when things happen, make them happen. Don't let them happen to you.
Yes. And I have provided the link below for the stress test events. That is our calendar of events. Like as I had mentioned, the event is going to be on the 19th next week and on the 20th. Very quick, only 30 minutes. So thank you, Rick, for inviting all of our participants to the event next week. Again, I do want to emphasize that our business counseling is no cost. So if you are interested, if your business is starting, it's ready to grow, or you need some consulting on sustaining it, please do not hesitate to request an electronic request form with us at maricopa-sbdc.com. We are here to help you all in all your business needs. Thank you, Rick, so much for your presentation. Please do not hesitate to contact us with questions, even if it's in regards to this presentation. We are here to help you all. We thank you all for joining us today, and we wish you a great day. And thank you once again, Rick.
Eileen, before we go, I see there's one other question.
Yes.
Someone is our client, but their counselor's not here. So if you send an email to info at maricopa.sbdc.com, we will answer it and we'll get you a new counselor.
Yes,
So
and I'm going to provide
info at maricopa-sbdc.com.
Yes, and I'm going to provide also my email down below in case there's still any questions in regards to the webinar or you'd like to reach out to me.
And Eileen, just to confirm, we will be sending this recording out to our participants, correct?
Yes, yes, thank you. Any final questions? Going once, going twice. Alrighty, thank you all so much for joining us today. As I had mentioned, my email is down below in case anyone has any questions or would like to reach out or any of that information. Thank you all so much, and we will see you next week at our stress test events. Thank you, Rick, once again.
Thank you.